In this video, we're going to talk about important price action pattern that under right conditions is presented as a high probability setup. As a price action trader, before I'm going to place a trade, in my mind, I go through 3 important points that all need to meet price action rules. In that way, I can maximize the chances of a setup working. And everything starts with the market structure analysis. So the structure right now is indicating basically clear trend range. We have flat exponential moving average, consistent price swings up and down. Remind you, I'm just using pure price action. Now, since this is a trend range, this means I have to locate the extremes of the trend range. So I'm going to draw the support at the bottom, resistance at the top, and I also want to respect the short-term trend line rule inside of this trend range, because every micro trend is part of a brand new trend line rule. There's a channel for each new trend, and I want to follow that trend line rule so I can understand if the trend is over or not. Because prices are right now breaking below EMA, this means that this short-term downtrend right now is expected to get new extreme tested. So I'd like to see pull back to the EMA and get a second entry short because it's the lowest low. There is first break below this bar low, so first entry short, pull back, and I'd like to see second entry at the EMA. That never formed a market created double bottom, very close to being a new extreme but not new extreme fully, because you'd expect a low that is lower than the latest lowest low prior to break. So this is still technically double bottom, but in trend ranges, it's definitely common for prices to bounce off the key level without fully testing new extreme. So we're going to confirm that by observing the EMA. If we can strongly break above the EMA, it's likely that the market is considering this as a new extreme tested. However, if the EMA is going to reject, there's a big chance there's going to be second leg down testing the new extreme. So prices are breaking the EMA sort of. The momentum is not as strong, so it's rather confusing. Now let's see what's going to happen. Okay, we're managing to close above EMA, and now we have interesting setup because this is hidden. We have a new low, we have first entry short, we broke low, we can see there's no break below here, no break below here, first entry short, pull back, it actually first broke higher, traded down, and then reversed all the way back up. So this is mini failed second entry short. It's not as easy to see, but because this is mini failed second entry short, some traders can already consider this expecting reversal because you're back above the EMA, and this right here can be considered as new extreme because you have triple bottom, and according to range rules, you're gonna buy low, sell high. So a lot of buyers stepped into the market around this level, push above EMA, but because you don't fully have new extreme tested, and it's not such a clean reversal pattern, I have to mark it a little bit more aggressive. Prices are working higher. Okay, at this point, if I'm going to draw a wider channel, you can see the wider channel doesn't really look that great. Why is that? There's empty room here, and there's so much empty room here. You can see how odd this channel is. So much empty room here, doesn't really fit that great. The market keeps going higher. So when this happens, this means there is a different channel, and I like to draw a spike and a channel pattern. We spiked up, we entered a channel pattern, and now you're definitely thinking bullish because buyers stepped in, push above EMA indicating reversal. Prices are above the EMA and we're going higher. So once again, as a price action trader, my goal is to always keep looking for these channels because they're going to keep me on the right side of the market. I can predict where the market is going to go by following these channels, focusing on these channels. We are breaking the spike and channel, so I would like to see second entry long at the EMA, something like this, because on the way down, I expect to break new extreme. Now, I expect breaking new high because we're breaking the uptrend. And our goal is probably the top of the trend range according to range rules that we expect. So we can get a second entry long. We cannot, the market keeps working higher. And notice the very strong momentum. We keep going higher, we keep going higher. And how steep the push is. And you can see we're completely trending higher. So this is massive continuation. I cannot deny the fact that the push to new high is so long, so substantial. There has to be a bigger pattern, okay? I'm not thinking about fading the breakout because this was so steep, so strong. You can't even pull back below the EMA. The uptrend is gaining some momentum. So when I'm watching this, it's probably time to draw some wider channel and adapt. Because after breaking new high, here you would expect some break below EMA, some correction, potential reversal. The fact that you keep going higher so strongly means that the channel is bigger. And also if you're going to take a look at higher time frame, for example, 10,000 tick chart, you can see that the move really looks like one clean push working higher. So it makes sense to be expecting now some bigger wider channel. The shorter term one served its purpose. However, I have overshoot, okay? Overshoot can generate stronger correction in the opposite direction. So when I'm watching this, I was expecting some stronger pullback. Overshoot can sometimes even reverse the market unless we keep working higher. And this is important, okay? Immediately after overshoot, break of the trend line, you expect very strong pressure in the opposite direction. Since prices didn't do this and we continue working higher, this means that there is no overshoot and I am allowed to draw a wider channel. Because once the overshoot is negated like this, the fact that there is no reversal, no stronger pullback, you can't even break the trend line, you can't even in fact pull back to the EMA, and you already broke the high, you keep working higher, this means that there's a wider channel in play and price action is giving me more information, so I am allowed to redraw a wider channel like this. Okay, so hopefully that makes sense. So right now the structure of the market is bullish. I have my key entry point, which is this uptrend working higher, and I have the EMA. So now the job is clear. As a price action trader, I'm not thinking about selling. I just want to see pullback to the key entry point in the form of a two-legged pullback, the price action pattern. We didn't get it here. We only had first entry long. So now market is correcting and we have first entry long here because we have a new high, no break here, no break here. We broke above this bearish bar. There was no break above the bullish bar, but technically the first entry long triggered here because this bearish bar is the first bar counting from this high that we broke its high. So there is first attempt, okay? It didn't happen above this bar, but it doesn't matter. There is the pullback, there is the first attempt to go long, which means I have to be patient because we're not interested in first entry long. I want to see second attempt. That's the two-legged pullback, that's the high probability setup, okay? And also the downtrend is in play. That's the important part of this price action pattern. I want to see downtrend getting a break new extreme. That's the sign that this correction played out, and then I can consider buying. So it's important to combine all of these rules. So I have the main uptrend, so I follow the trend line rule, but I also follow the mini counter trend line rule because it applies as well. Your break, push to a new extreme, and the downtrend played out. So the mini correction played out with the break, push to a new extreme. This is indicating to me, okay, bearish momentum played out, and we have new high, first entry long, pullback, second entry long. We have the two-legged pullback that if it forms under right conditions, and the conditions are, you have to understand the market context and needs to form the key entry point. This is going to be good high probability setup. Downtrend played out, you're at the EMA. You can also draw the channel a bit wider. You expect new high following the trend line rule if you have the channel tighter. If you draw it just a tad wider like this, you are at two key entry points. So this is great. High probability setup, second entry long at the EMA. Look at the tail at the bottom, massive reversal was happening. The bar looked very bearish, reversed all the way back up. It would have been better had we closed above EMA to give you that extra layer of confidence, but this is decent setup on its own. Can we get a high-low confirmation setup to confirm it? No, by the time we get a high-low, it's a horrible bar, too far up, you cannot take it, even though it worked. So I can now redraw the uptrend slightly wider. I can adjust it a little bit as I get more information because the structure still looks bullish. I'm going to redraw the downtrend and we keep working higher again. Okay, breaking new high and prices keep going higher like this. So when I'm watching this and I can see prices going higher, even though we have a breaking new high, the structure still looks bullish. Once again, if I'm going to take a look at 10,000 tick chart, the higher time frame, the overall structure looked like there is still bullish momentum left. I can draw a channel slightly wider because EMA keeps projecting here. We broke below for a brief period of time and we instantly pulled back above it. Push up, another push up, another push up. Every single time I can see so many pushes to a new extreme after breaking new high, it begs the question, is there a wider channel again? Because the price action pattern is being unfolded in front of me. So because the move looks so clean and so bullish, I was looking for some bigger pattern, something like this, because I still get the confirmation here. You can see first swing, second swing, third swing confirmation. So let's see how this fits. It fits pretty good. And I'm going to observe the EMA. This is important. In order for me to confirm this wider channel, I need to observe how the exponential moving average is going to react. If we're going to break below it, it's negating the wider channel. If this key level with the EMA is going to hold, it's confirming the wider channel and our bullish analysis. So we are already starting pretty good because these two legs are very broad. The broader these two legs are, the better. Because the broader they are, it means it's less likely for wider downtrend to be in play. This is horrible. We don't draw it like this. It clearly resembles one leg down, break, second leg down. One leg down, break, second leg down. So if I get a good bar, I can consider buying. Okay, horrible bar. I cannot go above this bar, but it gave you another opportunity. You can see how strong this bar is, confirming the key entry point, confirming the EMA. You can also view it as a mini fell breakout out of this sideways area, out of this consolidation, but mainly there's a two-legged pullback, so we can mark it as a two-legged pullback, second entry long, mini fail breakout, and you can enter once there is a break above this bullish bar, okay? Because the trend is strong, it's confirmed, the key entry point is holding, and this is a great hyper setup. Unfortunately, very hard to get filled unless you move your limit order one tick up or you use buy order, because there's a gap. You can see it never came back, never ticked back, pulled back, unfortunately, because a lot of buyers are buying at this important kilo. This is why these kilos, these key entry points are important, because they will show you where the buyers, smart buyers, are placing their orders. So we're using pure candlesticks and we're using market geometry to help us predict where is the right place on the chart to enter. The EMA is just a supportive tool. It's very helpful. It's a supportive indicator that can give us the extra bit of confirmation. And look at it go, brand new push phase, market keeps going higher. So the whole time, my strategy is the same, okay? I keep analyzing the market structure, I keep confirming the key entry point, and I'm looking for the high probability setup, the two-legged pullback. Okay, if there's a higher low, that's great. If there's failed second entry short, that's good as well. But the second entry long is the bread and butter, and you count it from each new high. Once there is a brand new high made, I have to reset the count. So we have a new high, first entry long, because we broke the bar high here, and a new high is made, so I have to reset the count. So market is going higher, new high, first entry long only, so I have to reset the count. This high broke the latest high, so new count here, new high, no break here, no break here, first entry long here, but I have to also redraw, divide it down. So you can see the first entry long is not as reliable. There's just a little attempt by the market, but you want to see that second attempt. After the two-legged pullback, the sellers will give up. You have a break, new extreme, downtrend played out again, and the same thing, by the way, happened here. You have a downtrend working lower, break new extreme, downtrend, break new extreme, great tail. Now, this first leg is quite scary. You spiked into EMA strongly. If you don't have two key entry points, let's say there would be no channel, just EMA, you'd have to skip this, because this is significant push down. Yes, you have a break new extreme, but the momentum is so strong, many times they want to see the break new low with the body. But because we have two key entry points, not just one, and it's been clean up trend working higher, you can consider another second entry long, new high, first entry long, pull back, second entry long. It fits the context structure, it fits the key entry point, and it is the price action pattern, and it is the second entry. And the downtrend played out. Market continues to go higher. Okay, new high can reset, first entry long, mini pullback, second entry long, but I of course cannot take, it's too congested, horrible bars, it's not even at the EMA, so no entry here. You can see how there's empty room at the top, it is time to roll over. But more importantly, the market soon is about to close and the buyers will take profit and the market close, because today was only half trading day. So this is the overall structure for today. It was a very good trading day to practice leg counting and how to count entries using price action counting technique, because identifying the bias is very easy. You basically spend the entire day in an uptrend. Locating the key entry point is also fairly easy because it aligns with the EMA, and then you're just waiting for the high probability setup. At the exponential moving average, you enter, place your stop loss one tick below the single bar, and just take the scalp. Today the ATR was low, so your scalp should be lowered. It didn't really matter because prices always generated very significant push, but you don't know this. And when the market is low, you should take smaller scalp. I'm gonna wrap it up. I hope you had a good trading day, and I'm gonna talk to you next time. Good luck to your trading.